Good morning, ladies and gentlemen. A warm welcome to this fourth edition of the Swiss Value Day. My name is Müller, and I'm responsible for client relations at BVM. And I'm very happy to co-host today's event with Alex Rauchenstein. He's the CEO of SIA.
Hello, good morning.
In terms of logistics, very quickly, you see that QR code on this slide and on the next one. For those interested in accessing the slides during this presentation, you can actually do that via that code on this and the next page. We'll also have it during the break, so you can follow the slides if you so want it on your own device. Now, in terms of the program, Alex, SIA, and BVM together, we launched this event a few years ago because we felt that value invested deserved more limelight. The style had been going through some difficult years, but we both felt that the auspices for a rebound were really good, and that, that from a timing perspective, having a Swiss Value Day would be something that was very interesting. And indeed, thankfully, particularly also for us, BVM this year has been fantastic. There has been a really nice rebound, and we've got something exciting to talk about also in terms of the outlook. And so with that in mind, we wanted to, with our program, present the broad appeal of value investing. And as a start, we'll have Georg von Wyss, my colleague at BVM, who co-founded the firm in 1997, who will present the case for investing in Europe. He'll be followed by Hernandez, managing partner at SIA, who will provide insights into how to navigate potential recessions. As in previous years, we'll then have a fireside chat navigated by Gregor Maus from the market, together with two of our guests that we have here today. We're extremely pleased that we are again joined by fantastic value managers with a great track record. On one hand, we have from Madrid, Beltran Paragues, who will join the fireside chat and also later present an investment case. And on the other hand, we have Jay Hill from Tweedy Brown, renowned value investor from Stamford, Connecticut, who will also participate in the fireside chat and present a very interesting investment case. Now, these investment cases, the way we will have them today is in the form of a round robin, i.e. we have 4 presentations on these 4 firms, followed by interviewing at first by colleague analysts from other firms, with a view of making it as interactive as possible for the audience. And then later, we'll also open it up for questions from the floor. Last but not least, we're very much looking forward to continue to having discussion afterwards at the buffet lunch, which will both be inside, and we also have some outdoor area that's accessible. Before I hand over to Alex, just very briefly, a few words on our firm, BVM. We focus entirely on managing 2 value funds whose portfolio are very similar. The investment team has been working together for 20 years and consists of, aside from Georg von Wyss, also of my colleague Pascal Prüss, who's one other person who will present an investment case. And then Markus Kausen and Lars Celsos, all of which are here today in the audience. And then we also, you probably met earlier, have our Chief Operating Officer, as it is, Daniel Jordan. We've been at it for over 27 years and started at that point in time the Classic Global Equity Fund, with which you might be familiar with. We're all substantially invested in the funds to assure that we're aligned with our clients as much as possible, and we're set up as a partnership. I very much hope that you enjoy today's program, and I'm very glad to hand over to Alex.
Urban, thanks a lot. So Urban and me try to be a nasty one in the sense that we try to go through the program on time like a Swiss officer. You see here this nice picture of Lachen, which is the office place of SIA. I'm here today with Marcos Hernandez, who is my managing partner, and also here with us today is Urs Marti, who is our natural resources guru, and we basically manage a natural resources fund and the value fund. And just a couple of words from my side, because I don't want to keep you waiting to then listen to George. I actually wanted to basically give a certain foundation. Where are we today with the value cycle? This chart I found particularly interesting because, you know, MSCI World data usually starts in 1973, and then you don't see things like the railway bubble or basically the Nifty 50 bubble. You then, of course, see the TMT bubble, and this chart stops in 22. So basically, if you would go through 24, you would end up being here. And here we are not talking about MSCI World, we are talking about MSCI All Country. But at the beginning, of course, you didn't have that index, so somebody really did the work, put everything together. And for me, it's absolutely clear that the saying, history is not going to repeat, but it rhymes, it's a perfect sentence. And the older you get, the more clear it becomes. And sometimes you think it's pretty easy. Now, at the beginning of the year, Goldman Sachs put out some charts, which were pretty interesting, because they were showing the money inflow into the US in 23, 24. And the lines down there are not interest rates in Switzerland, they are actually the fund flows to the rest of the world. So basically everything was just rushing into the US. And wherever I went, be it a retail investor or be it a large pension fund, they told me, why should I pay an active manager something when I can get MSCI World for free and S&P for free, almost. And then I told him, listen, at least know what you own. And sometimes it was a surprise, but they were not knowing that they own Tesla. Because a couple of minutes earlier, they told me how stupid Tesla is managed and it's going to collapse. And then later on, they said they are fully passive. I mean, that's where we are, that a lot of investors do not know what they actually own. And the right-hand chart, I do not comment too much because George has a similar chart. And you see here, that's the railway bubble. And we have been exactly where the railway bubble was. Now, a very interesting chart was also stated by David Costin at the beginning of the year, saying that with the current valuation, and we are pretty, again, on the same level, the S&P for the next 10 years can only yield how much per year on average? 3%. 3%. And if you listen to the guys today, we have IRRs in the 14, 15, 16%. So I think we can offer an alternative. It doesn't mean passive is bad, but maybe think of something else as well. Now, this chart I had to bring, because if you look at the 10-year rolling returns since the 30s, you realize that there were just two long phases where actually value underperformed substantially. And we have been living now through the longest period of underperformance of value ever. And the right-hand chart shows basically when should it change. And it's basically looking at the rolling window of 3 years inflation in the US, and whenever this is above 2.5%, this professor from Toronto came to the conclusion then it's time to go back to value. And this chart stops at 2019 in October. So let's see what happened after. The brown line is nothing else than the MSCI International Equity. What is this beast? This beast is nothing else than MSCI World ex-US. So without US, as a growth investor, you were down here. As a value guy, you were up here. So since 5 years, the renaissance of value investing has already started. Not if you include the US, because the large 7 or 10, they were putting a cloud in front of the sun. Now, our fund is the blue line. I don't comment too much, but we think there is nice opportunities. And with that, I hand over to Georg.
Thank you, Alex. To talk about, I'd like to motivate or to show you what a great place it is to invest in Europe. And I do that partly because we're 80% invested in Europe and have been for years, and it's been terrible. But that's going to change. I'm going to show, let me go through 4 topics. One is to go through again, or Alex has already covered some of these themes, but why America's been such a terrific outperformer. Then go into why I think that's over, that Europe is going to be coming back, that its strengths are there, they're just overlooked. And then specifically how European value stocks are very interesting. So, this is the reverse of the chart that Alex just showed you about growths and values out and underperformance. You've already seen it. Growth has had an incredible period of outperformance. This is on the basis of 10-year returns, comparing growth and value using the Fama and French database. So as you can see, it's quite unusual for growth to be better than value, but that's exactly what we've had. The reasons for it, Alex touched on some of them. Let me say a first one that was good for America in general is that falling interest rates and falling tax and interest rates drove enormous net profit growth in the United States starting in 1989. So that was good for all stocks. But interest rates the falling interest rates were particularly good for growth stocks because, as you know, they're all about future earnings, which you then discount to today. And of course, they're more valuable when interest rates are low. And then, of course, what also happened in the United States, you've had enormous wealth creation through these large cap tech monopolies that have developed. And that is true value creation. What happened to the value investors, we got trapped in a negative feedback loop. We didn't perform very well. We got hit by redemptions, so we sold cheap stocks, and then we got more redemptions because our stuff didn't perform because we added to the selling pressure. The result, as Alex showed you, is the excessive market concentration. This is the yellow line is the chart he already showed you, which we all borrowed from Goldman Sachs. On the orange line, we've added just the concentration of the S&P 500 for as long as we can measure it, and that's taking the top 10% of stocks over the last versus the market capitalization of the entire index. You see that they're essentially parallel. The interesting thing is if you overlay the value growth chart with the concentration chart, they're extremely correlated. In gray, you see the areas where we value investors did less well. It's those phases where market concentration went up, when people were chasing the same wonderful growth stocks. The phases in white are where we value guys felt great about ourselves and thought we were top of the world, and that's when concentration was falling, when people realized they were overpaying for some of the wonderful growth names, and that it was worthwhile looking at cheap stocks as well. I think we're at the start of one of those phases. If you look now how small value investing has become relative to the entire market, you could do it by sorting the 2 largest indices, the S&P 500 and the Bloomberg EDM, into quintiles. So we take the top 20% of stocks, the next 20%, et cetera, and then we measure their market caps. And in the blue on the bottom is the cheapest market cap. You see that that quintile has become a very small part of the market in the United States, but it's also become a small part of the market in Europe. From a bottom-up perspective, what does that mean for someone who's trying to do value investing in this environment? Well, let me take a step back, tell you how we work. Basically, what we say is we try to estimate what a stock earns over time in terms of cash flows and earnings. So through the cycle, what's its normal pattern of earnings? And then we say, what is the normal valuation that attaches to that? That gives us a value of the stock, which we then discount to today, and then we buy if it's still cheap. On that basis, what you're really looking for is good earnings growth, or companies that are growing their earnings, doing well over time. And you see that here for our portfolio, just as an example. On the x-axis, you see the earnings growth over a 5-year period. So ending last year and then the 5 years before, did earnings grow up or not? If they did, it's in the green part of the graph. The total return is measured on the y-axis. And what you see is that 3/4 of the stocks that we picked did grow earnings. And you could say, shame on you, 1/3 didn't. But 2/3 did, that's okay. But still half of them fell in value. And 2/3 were below the diagonal line. And the diagonal line just is the point where if your if your total return matches your earnings growth, you're staying roughly the same in terms of valuation. So 2/3 of the stocks got cheaper. You could see that too in the price-earnings ratio of our fund, which fell and fell and fell. Normally, you would say a value fund like ours would have an average price-earnings ratio of something around 11 in our case, maybe more depending on the style. But you see how the line kept coming down. From 2013 to now, it's been coming down. Until very recently, of course, this gives us it gives us some cause for optimism that things are going to get better, or are getting better. Now, what's happening in the United States? On the one hand, you've got the enormous debt that's building up. We all know about that. Here you've got debt to GDP in the USA in blue and in Europe in green. Europe as a whole. So that includes, of course, Germany and the Netherlands, where it's quite low. But you see, for all of Europe, it's a low number relative to the United States, though in absolute sense, it's not that low. Then we have problems with the Americans undermining their financial system by calling their statistics into question. We got stories that the CPI collection is no longer as good as it used to be. We have stories that an innocuous report like the Farm Trade Report was delayed and then issued without the commentary because they were afraid that President Trump wouldn't like what was said in that. And then, of course, we've got all the silliness coming out of the Department of Health and Human Services, where you just don't know what's going to, if you can trust what they say anymore. And the quality of American statistics has always been one of the great strengths of that financial market. Then, of course, you have all the policy uncertainty. Tariffs go up, tariffs go down, tariffs go up, tariffs go down. You've got the deportations, which are going to take out an enormous workforce of people who are doing the low-paid jobs, if they actually go all the way. And the result of that is it's very hard to plan anymore. You see how in the beginning, when it became fairly clear that Trump was going to get elected, people got more optimistic. This is the Purchasing Managers Index. And since then, when people realized that he actually meant what he promised, things are coming down. So the PMIs are falling in the United States. This chart is a little hard to read, but I'll explain it. It shows you on the left the number of Nobel Prize winners by country, and I've highlighted two relevant ones. One is on the top is the US, and then the third one there is Germany with the D. Each dot is a Nobel Prize. The chart goes from 1900 to 2010, and the yellow part shows you how Germany stood before the Nazis chased away all the wonderful scientists they had pushing all these advances in physics and chemistry. And look what happens to the United States after World War II. It's enormous. The amount of Nobel Prize winners is huge. And that's because so many immigrants were part of that, were important to those Nobel Prizes. Over a third, if you look at the statistics. And of course, European universities are quietly going crazy trying to recruit the best scientists from America at this point. If this goes on, it's a real problem for the Americans. Then, of course, they're hurting their other soft power strengths. You have all these issues with the rule of law. The executive orders against companies that Trump issues are in and of themselves chilling because nobody wants to go to court to fight them, even if the legal basis for winning them is actually quite good. Then, of course, you've got the troops in LA, which is a bad look, etc. And let's not forget, throughout history, we've always had societies that have done things like that hurt themselves economically, and they've done them on ideological and religious grounds. So for further examples, France expelling the Huguenots, the Turks killing the Armenians during World War II and then throwing out all the Greeks after I said World War II, I meant World War I. The Armenians got massacred in World War I, and then the Turks threw out the Greeks in the 20s. In both cases, those were economic elites, and losing them was a big blow to the Turkish economy. Then as a small local example, Zurich chased out the merchant class in the Zunftrevolution of 1336 that caused a few hundred years of economic stagnation in my hometown. Investors are leaving the US. You can see that because yields are up and the dollar is down. Normally, when yields rise in the state, the dollar goes up because it becomes a more attractive place to invest. But again, as the markets start to realize that Trump means it, we see that the dollar weakens even as yields rise. And that's a sign that people are slowly, bit by bit, going away as the Americans slowly undermine the strengths of their capital market. At the same time, people are realizing, gosh, it's not so bad in Europe. We have some structural strengths. We have stability in the rule of law. Sometimes we have too much law. We have over-regulation. But at least people realize that's a problem at this point. And then, of course, we have a commitment to open trade. We have very few tariffs on few industries. And therefore, European industry in those places where it's survived is quite competitive. And then we also have government policy that until now has been rather bad, but it's going to improve, and that's important. The inflection point matters. It's not that the policy per se is bad as much as that the policy is going to get better that matters for the investor. So we may get a reduction in overregulation. Brussels is promising that. Let's hope they do it. And of course, there's, with the German stimulus program, we've got more fiscal expansion to look forward to than the Americans, where if they do what they need to do, they would have to raise taxes. So at some point that's going to have to happen. They can't raise the deficit forever. Then Europe has a well-educated workforce and relatively low drug use. That does matter. On the left, the UN Education Index in blue, all European states, and I don't mean in a political sense, I mean just geographically. The United States is in red, so it's fine, but the rest, most Europeans are better. And on the right, you've got drug use. That's the prevalence of use by various drugs. Also data from the United Nations. And this matters. I have a company in the portfolio that I follow called Wacker Chemie. They have two plants that make a high-energy product called polysilicon, one in the United States and one in Germany. So it's obvious that they would invest in the United States because energy is much cheaper. But they're not. They're investing in Europe because so many of their applicants fail the drug, the people who are applying for jobs fail the drug test. They just can't get the labor force that they need for this very difficult to manufacture product. And Jay from Tweedy, who you'll meet in a minute, told me that there's a plant that there's a company in Indiana that stopped doing drug tests because otherwise they couldn't staff the factory. Think about that. Think about that. Then, of course, we've got strong manufacturing despite high labor costs, as I mentioned before. In Europe, manufacturing accounts for 15% of the economy, 10% in the United States. The United States services are stronger. You see here how important that is in terms of the export statistics. This is EU trade with the United States by product group. I apologize for the small print, but we borrowed this chart. On the left, this is 2014, and this is 2024. And everything blue is basically manufactured goods. And you see how those exports have grown faster than the economy has. That's because the stuff is competitive. Americans want to buy it. And that's, to some extent, a protection against tariffs. Not all, but some of these products are unique, so that even if they cost more, they need to buy them, especially, for example, capital goods, where if you're going to be reshoring, you're going to have to buy a paint shop from Dürr, a German company, because there aren't that many companies that make paint shops if you want to build a car plant. So putting it all together, the European purchasing managers are actually getting more optimistic as American purchasing managers are getting less optimistic. Whereas on the services side, things have bottomed, at least that. So, European value stocks are attractive. I show you two charts, left United States, right Europe. All the lines show price-earnings ratios for these indices. On the left, the MSCI growth and value indices, and that's just the cheap, the expensive half and the cheap half of the index. In blue, growth, and green, value. And you see that in the United States, growth is still pretty expensive. It's come off its highs, but it's pretty expensive, whereas value is not cheap. It's okay. Historically, it's okay. Given the fact that interest rates have risen, it's probably a little high, but it's not crazy. Whereas in Europe, growth has also really gone up a lot versus value over time, and has corrected recently. But value on a historical basis is actually pretty attractive. So that's the view from 15,000 meters. Then if you look at the European index, how the value, they split out in terms of what's cheap and expensive inside the index, we took the Bloomberg EDM, which I showed you before, and again, we took those 5 quintiles, and we took the median PE in those, and you see how the expensive ones have gotten more expensive over time and are pretty expensive still, whereas the cheapest 20%, which is where we fish, that's really low. It's still very attractive, even though we've had a little tick up recently. So, last thing, as a value investor, I don't normally do this high-level stuff. I just do it because Urban made me today. I'm interested in stocks. So I did a screen. In the US and Western Europe, I searched on Bloomberg for all companies with a market cap over $500 million with net debt to EBITDA of under 2 times. So that gets me an investable universe, if you will, of healthy companies. The number of companies trading below price to book of 1 is about 80 in the United States, 120 in Western Europe, even though the pool in America is 1,000 companies bigger. So on an absolute basis, there's more cheap stuff here. And then if you do the same thing with a PE of less than 12 times, you get almost twice as many companies in Europe as you get in the United States from the same pool. Now, I've included the 5-year historic sales growth and the return on invested capital statistics for these 2 groups of companies. The US companies are better. There's no question there. So of those 202 companies that you potentially could sift through, you have to be careful you don't catch too many duds, because there are some in there. But I submit that we probably have some really interesting stuff to look for still. And of course, we're holding it in our portfolios. And it is no surprise that the 4 managers that you're going to hear from later today, every single one of them is going to be pitching a European stock. It's not because we all got together and said, hey, let's do European stocks because make George look good. It just happened that way. I noticed it after I did this presentation. And so I think that's kind of another, if you will, a sort of a small indicator, a piece of anecdotal evidence that Europe really is an interesting place to invest. And you'll hear about those cases in a minute. Thank you very much. Let me just summarize. The stocks are cheap. The balance of risks and opportunities is switching from the United States to Europe. I'm not saying America is a terrible place to invest. I'm not saying the country's going to hell in a handbasket, but things are just getting relatively better here. And tariffs will hurt us, but we have some terrific exports, and in the meantime, we also have some terrific domestic companies. And so if asset allocators, who until now, as Alex is saying, have been shifting all that money to the United States because it was the easy way to win, just move a little bit back to us, it's going to make a huge difference because, as I showed you, we've become such a small part of the market. And that means nice performance if all goes well. I thank you for your attention, and Marcos, you're up.
Okay, good morning. Thanks a lot for coming today. It's a pleasure to be here. It's the 4th Value Day, Swiss Value Day, and it's always good to be here presenting our thoughts and sharing our experiences. So in April, I was thinking what to touch today in terms of sharing ideas with you. And then in April, if you remember, we had Trump, we had Liberation Day, and then the markets quickly corrected, and then some of the brokers and the participants said that the recession probability was 60, 70, 80%. So I said, okay, let's touch how to survive, how a value manager survives a recession. So you see here that, most value managers, we don't think that macro is the main driver of investing. We invest in stocks that we select for the long term at a good price. But there is an obvious correlation between recessions and market corrections. So in this past century, you can more or less highlight 12 recessions, and you can see that the indexes, most of them are down between 20 and 50%. So I'm in the market since 1992, more or less 30 years, and I've lived half of them. And it's really amazing, this correlation. So now Trump gets there, Liberation Day, and even now, no? Yesterday, Israel has attacked Iran, so there are chances of recession. So what should we do? Is going to be a recession? Nobody knows. Nobody knows, and we cannot really know. So this is psychology. There is an economic downturn, there is fear of recession. Even if there's no recession, then the market collapses. There is massive negativity and panic. So, you know, as a portfolio manager, what you get is amazingly negativity. You have friends, family, very scared, media completely negative, you know, focusing on the negative news that sell more, brokers, experts, momentum, because people are looking at the next 6 months, not over the long term. Mr. Market enters in panic, and the day-to-day is really awful. I can tell you, you have NAV going down every day 3%, investors calling, redemptions every day, profit warnings from the portfolio. It's really a nightmare for a portfolio manager. You need to really be very strong and very experienced in order to pass this. And then the business model doesn't help. You know, this is a model that I built very, very simplified from a kind of medium-sized asset manager. 1 billion asset, which is not bad. Then you get fees after cost of 7.5 million using 0.075. Cost of the team, $5 million with some analysts, with some portfolio managers. Pre-tax profit, 2.5. And what happens is that in 3 months, you get a 35% correction of the market and then a 10% redemptions, and your assets go from 1 billion to half of that. The costs stay, which means that the pressure is not only the market, it's also the companies, it's also the entourage and the company. So you really, it's a big nightmare. If I would assign a risk category to this business, would be a 4, so high risk, and also high return, because initially boutiques are more efficient. They should make more returns than the large institutional investors. And you see that in the portfolio managers, how many old portfolio managers are there. There's not too many, because if they do well, they retire, because they don't want to cope with this crisis. If they do bad, you can imagine what happens. And Buffett, he showed the way out with Berkshire, so how to take an asset manager out of the noise. And this is a friend. This is an electrocardiogram taken in the COVID in 2020. So you see the anomaly there. It's, you know, physical reaction. Even if you are really understand where you're invested, you normally fight against everybody, against your investment committee, against your family, against everybody. And you need to really be very strong. And this is the price we pay. And we pay this price also for our investors, because we need to be prepared for that. So what should we do in case of a recession or a crisis? Think long term. Think like a businessman. I mean, nobody sets up a company in order to make money in 6 months and then sell. If you set a company, you want to be there compounding cash flow for many, many years. Obviously, you need to review all the investment cases, because recession has an impact. Then you need to go through all the companies and see what is the impact. And we did that in the several crises, and it takes a long time. Cross-check. So personally, what I have is a group of friends, very experienced, that I, lean on when there is bad moments, and do nothing, because in a crisis, in a recession, you need to be ready before. If you get to the crisis, to the recession, the portfolio is not well structured, it's too late. If you change the portfolio in the middle of the recession, you can make a big mistake. Will it happen again? You know the response. So the economy is cyclical. You may have a war. Fear is basic psychology. And then most of the market participants really do not know well the stocks, and even worse with social media. Social media is just putting a lot of news out there that do not make any sense. And even modern finance, there's too much momentum. So in the end, it's pro-cyclical. When the cycle goes down, well, everything is bad, everybody follows this momentum. So this is the negative. Let's go to the positives and the real world. It's a fantastic opportunity. If the market corrects 20, 25, 30% is a great opportunity. And let's go to the basics, is what Warren says: be fearful when others are greedy, and be greedy when others are fearful, and most people get it backwards, which is interesting part of the quote. So 2 comments here, very important to understand difference between price and value. Price is what you pay, value is what you get. Second is the margin of safety. Margin of safety is not only that you are protected in a downturn, all of us buy cheap because we are value guys, but it's also you enhance the returns. If you buy the same company with a 30% discount, your return will be bigger or higher. I chose that to give you an example on that, to tell that the companies can be valued, that you can calculate an intrinsic value for a company, you can calculate an expected return for every company, and I chose the housing because it's easy to understand. To value a house is relatively easy. The intrinsic value of a house would be, you can see 3 ways: replacement value, so land, construction cost, other costs, or the NPV of rentals, or transactions in the area, right? Trying not to measure that in a bubble or in a depression phase. So if you do this calculation and your house is $500,000 value, I mean, would you buy another one when the market says it's 1 million worth? Would you sell it at 100,000? Doesn't make any sense. So I wanted to use this because it's more visible than doing a valuation of a company, but it's the same mechanism. And then you can say, well, Marcos, you're too simple. We know all that. I mean, all this is so easy, it's basic. Well, this is Magellan. This is one of the best funds. Until 2000, the compound rate was 22%, Peter Lynch. And so the red line, you see the performance, 20% plus, amazing per year. So this means double your money every 3 to 4 years. The blue line is the assets. So if you realize that half of the assets, so the fund went from 40 billion to 120 billion assets in 5 years. So half of the fund bought at very expensive prices. So what happened then is normal. Basically, you see that the fund starts to underperform a little bit and the assets go down, which means that if you calculate performance of the Magellan fund weighted by assets, it's single digit. Why? Because people buy here and sell here. So now the contrary, what we went commenting on the housing. So it looks easy, looks basic, but nobody does it. This is what we try to do at SIA. You know very well that we calculate intrinsic values and IRRs per stock, so we have the average for the fund for many, many years. So Alex did this chart where you see the IRR is quite stable of the classic. It's a global value fund. And you see that in COVID 2020, and I highlight this because in another slide I will comment that, in COVID, stock market and the fund fell 35% and the IRR went up to more than 20%. And then you see what is the normal pattern. So basically our IRR is trading on normal markets at 14% IRR. When it is cheap, it goes to 16, gets expensive, it goes to 12. So this is an anchor for us. Forget recession, forget momentum. You buy cheap, you sell expensive, you rotate things, and then in the limits, in the high, when there is a big crisis, then you need to really double down and triple down. And I will comment on that. But the question mark is, what do you do when the IRR is 20% in the middle of the COVID? Is you buy. And that's it. Conclusion, buying cheap, sorry, but it's as basic as this. Companies can be valued. There's a lot of portfolio managers that I hear out there, they don't have really intrinsic values, IRRs, and then I think, well, it's easy. Who has an IRR on Tesla? It's really meaningless. So also you need to be in your circle of competence and value what you can value, right? Portfolio has to be pre-prepared, and this is Warren Buffett. He says you need to be ready, and portfolio needs to be built in order to cross cycles. And then money follows momentum. It's pretty basic, but it doesn't work. People will buy here because everybody is very positive and sell here. We do the contrary. And a comment from Warren, he says, Charlie and I rarely get the same IV. So there is an art in the calculation of IVs and IRRs. So how we evolve within SIA? So basically, very easy, we did 3 things. We focus on quality, so we used to be more deep value, now we are more quality value or strategic value. We buy at a discount what only good businesses. We don't buy, we used to buy very, normal businesses at a deep discount. We don't do that. Now we want businesses that generate value across cycles. And then we have a kind of unique or different portfolio construction, which I will comment quickly. And again, predicting rain doesn't count, building arcs does, and this is what we try to do. So very fast quality. We do strategic analysis of the sector. We do strategic analysis of the company. This is Porter. And we choose the multi-businesses. So entry barriers, to put it simple. And we say the 4 Gs in order to be easy to remember: good business, good balance sheet, good management, and good price. We are cheap. This is the PE of our fund, 13 times 2025, 11.6 times 2026, price to book 1.7, MSCI 3. So we are cheap, we buy at a discount, even with quality, and this is, by the way, the classic return on equity average is above 15%. Third one, concentration and diversification. You can see in one slide half of the classic book. So you can very easily understand where we are invested. Plasma proteins, cleaning, OTC and consumer products, food and meat vouchers. Medtronic is medtech. Leroy is salmon farm. ASML, semiconductors. You see here that in 10 names, where there's half of the book, there's not really a single driver that can kill me. Nothing, no China, no sector. It's very well diversified, and it is very well concentrated. And this is also something we do differently in order to take advantage of the market recessions. When the market gets expensive, we buy more quality, 1 and 2s. Now we have 2/3 of the book in quality names. When the market crashes, high beta, 3s and 4 that are more cyclicals, they fall more, and we change the portfolio. We buy what is down a lot. And this we really tested just one time, big time in the COVID, because you don't have many recessions, and I will tell you what happened. This is the COVID test. You remember the IRR when in the old slide was 20%. This was COVID. 5 years later, the IRR of the classic, 22%. It is working. If you do 1 DCF, maybe the model is not very sound. If you do 35, you have assumptions per company, too many assumptions, too many margins, too many. So it's really a robust model, and it's worked. And we are very happy that, reversing the portfolio when there is a crisis, you take the opportunity to invest very cheap, even in quality, in high beta stocks. So what are we doing now? Basically, we entered in 25 very high in 1 and 2, so kind of quality defensive, entre guillemets. We had 8 or 9% cash. I had that for 2 years, too conservative. Probably I lost some performance with that, but I was kind of fearing a recession. And then we got a bid on one of our names, Catalana Occidente, an insurance company, so the cash went to 12% just before the Liberation Day. And we have reinvested that, 50%. 50% of this has been reinvested at the lows. And we were saying, okay, if the market falls another 15%, then we will reinvest another 15%. So the thing is, when you see that clearly, the IRR is very high, but you don't invest everything in the first moment. Just wait, and more or less our time horizon to reinvesting would be, I don't know, 3 or 4 months. Now the IRR of the fund is 16.5, so there's still a lot of value. This is pre-fees. And think long term, this is the classic since 2012. It's been 14 years. So I'm managing the fund with Carlos until 2019, alone since 2019. Then we have the investment committee, obviously. It's 10%. So forget the recessions. 10% is doubling your money every 7 years. And the portfolio is quality and the portfolio is diversified. So I don't think why we should just change it. But the thing is, these recessions, the big one, the white is COVID, and the red one is the Liberation Day. We use them to enhance the returns. Then finally, a couple of minutes from me. What do we have? This is the same message. It's a little bit less technique. Basically, I try to identify growth cycles and value cycles, and you see that in the last red line, you see that the last growth cycle where value has underperformed has taken 15 years, basically since 2010, more or less. So 3 value cycles and 3 growth cycles. We think that we are entering, I agree with Alex, and we are not coordinated, so Alex is free and Georg is free, and everybody more or less comes with the same conclusion. We think there is a new value cycle starting. Why? Valuation. Growth stocks are on average 26 times earnings. Values are 14 times below historical, so there's a big gap in valuation. We see the Magnificent Seven and the US big stocks maturing, so they are heavyweights in all indices, so they should have an impact. And then the economy, as we were discussing here, we move into a more inflation area. High inflation correlates with value, correlates with commodities, correlates with capex. So we think that we're going to see, I don't know, I hope 10 or 15 years of value outperforming. And this is the same message, value has lost market share in a big time. So this is the global value funds as percentage of large caps. This is a light blue line. Market share was 30% in 06, and now we are moving 5 to 10%. So really value is almost out of business. And the same with the weighting. America, the weighting on the MSCI is 70% plus, and the weighting in GDP is 25. We are not saying that this will correct tomorrow, but we say that the index is heavy weighted in the US is heavy weighted to the Magnificent Seven, and the Magnificent Seven are quite expensive, and they are so huge that growth cannot be double digit anymore long term. Conclusion, we think there's a new value cycle. It should be long. It takes 10, 15 years normally. We think active management should regain some share, and our fund gives 15% return net of fees now. Our numbers indicate 15%. You can make mistakes, you can make successes, should be more or less feasible as we show with the COVID. And this compares with what Alex was saying. The MSCI, according to Goldman, is expected to do 3. So, I think we can get some conclusions here. Value should be there for the next 10 years, hopefully beating the index. And then passive cannot work if the index does not do 10%. Passive has been easy, ETF has been easy, index has been easy because the market has been doing 12, 13, 14% for 10 years. We think that this is over, and slowly we will go to a mean reversion. And I think, 1 second of advertising. This is our proposal, quality value. We are small, non-institutional, a lot of experience. We are obsessed by risk. Track record, 10, 11% for 15 years. Long term, and very transparent. So we are here to talk to you after in the cocktail. Thank you very much.